rock and roll with today's afternoon meeting. I am an associated member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure, again, my swings here have not changed, I think, for like the third day in a row. Market hasn't really changed too much. I did take a couple day trades today, which we could chat about in today's afternoon meeting, but honestly, nothing spectacular. I was really looking for that range expansion today, and it didn't happen, so we can chat about that. Let's jump into it. So here's our big picture technicals for the SPYs. Thank you, Pat. So here's our big picture technicals from the SPYs. Where did we close today? So S&P is up about 0.2%, 0.25% or so. NASDAQ is down about a 0.25%. And probably the most interesting index today, the Russell, up 0.5%. But interesting intraday V-bottom action and an interesting little daily candle that the Russell gave us. So chat about that in a second. So once again, all-time highs for the S&P. Is anyone surprised? Raise your hand if you're surprised. I'm not seeing anybody's hand raised. It's a bull market. We know it, right? It's a bullish pattern in a bull market. I just really thought maybe we could see some range expansion today, and we really didn't get it. That's kind of the only disappointing thing to me. I wouldn't necessarily say it's a surprise so much as it is a disappointment. The last 3 days, and then honestly really today, the intraday price action in the market has just been kind of brutally boring. Common gap to the upside. We went sideways. Moving averages caught up here on the small time frame. This is actually technically really bullish price action. Zero upside follow through. Then we actually broke down to fill the common gap midday. Midday is when our low comes in. No real signal here that that's going to be any type of low. And then we, rallied back to almost near highs for the close, giving once again a really tight, boring day here for the SPYs. Qs are a little bit more interesting. I referenced in yesterday's afternoon meeting and again in this morning's morning meeting a little bit of concern that I have on the NASDAQ. I don't want to jump the gun on it. It's definitely still a bullish market here. But the candle yesterday was a little bit weak. Today's candle was a little bit weak. We are still just in that equilibrium area. We are still well above all major support levels for the NASDAQ. So nothing to be too concerned about, but it's interesting to note we now have 2 days in a row of relative weakness coming from the NASDAQ. And if anything, that relative weakness seems like it's delayed to me. I expected a lot more relative strength from the Russell and correspondingly a lot more relative weakness from the NASDAQ when this TLT first broke down here Friday last week, August 6th, when we broke this ascending trend line and we got back below 150 in the TLT. Interest rates started to go higher. That tends to be not so good for the NASDAQ. But the NASDAQ held up pretty well. Where's the 8th here? Yeah, the 8th. Sorry, was it the 6th? Which day was it that the TLT broke down? 6th, right? Yeah, the 6th. Sorry, gotta get my eyes fixed again. Yeah, the Qs held up really well on the 6th. They held up really well on the 9th, and it was only the last couple of days as the TLT has kind of continued to bleed a little bit lower did the Qs actually start showing some relative weakness. Correspondingly, I was surprised that the Russell wasn't stronger on the 6th and on Monday and on yesterday. We haven't been able to get any real follow through here from the IWM, which again is a little bit of a surprise just with TLT breaking down, interest rates moving higher. That tends to be better for these IWM type names, better for financials, better for energy, better for the reopening reflation type trades, and worser for the NASDAQ. But this is an interesting candle here from the IWM. Intraday price action on the Russell, again, common gap to the upside. They broke this down hard and fast in this first bar, so maybe we did get a little bit of range expansion if you specifically look at the NASDAQ. SPYs definitely not. Led to some weak price action here for most of the day, and then at 11:50, without really too much of a signal, fine, a little bit of a pickup in volume on this 5-minute hammer that's got a little bit of extension, leads to a V bottom where we just V-bottom and go into this accelerated uptrend for the second half of the day, closing really strong. And what that creates is this candle here. Now, I don't like to overread the shape of a candle when it's within the confines of a consolidation. Because what happens when you have range-bound sideways price action is candles almost close somewhat haphazardly. And if you treat every single candle within the confines of a consolidation as something that's actionable, you're liable to just kind of churn your account and not really go anywhere. So for people who have partaken, yes, I will talk about that, Robert, thank you. Let's just do a quick review of the market. For people who have partaken in my candlestick class, you know that when I care about the shape of a candle, or when I really care about like a hammer candlestick, something like this, is in periods of extreme. You have that downside extension and that volume really picks up, and then you get a candle like this on high volume. That's something that's significantly more actionable than when it's in a range. But it is relative strength. And relative strength, we know, has been really important in 2021 so far. So IWM up 0.5%, Q is down 0.25%. There's relative strength there, and the internals of that relative strength combined with the internals of this candle may mean that we need to keep an eye on the Russell for going forward. As a couple people reminded me here, I mentioned in yesterday's afternoon meeting, and of course I will take questions on everything, but I mentioned in yesterday's afternoon meeting that we were going to have a discussion on tier sizing today. Tier sizing can be a little bit of a boring topic, but it's really important, and kind of how I choose how much tier size I take, and kind of what I recommend to people. So tier sizing, right? How much stock do you take in a trade? The way you come up with that should really be backwards math. What I do not support, there's a couple of things I really don't support that have not been professional traders as part of this group. When I'm speaking to people who are like in the retail world or whatever, who are thinking about making a transition into professional trading, I'll usually pepper them with a couple questions on risk management and their trading approach, kind of things like that, to get a feel for what they've been doing on their own. And a couple things I disagree with. One, I disagree with just taking the same amount of tier size in every trade you take. I take 400 shares in every trade. Okay, well, taking 400 shares in a $600 stock and taking 400 shares in a $6 stock, you're looking at potentially very different risk amounts, potentially, because really it's based on space. Another thing I really disagree with, which we can talk about maybe in a different day, but I hear this all the time from people in the retail world, is I really don't like the random stop losses. I hear people all the time when I ask them about, oh, well, how do you manage risk in your account? They say to them, I give everything, and then they give me some random percentage amount. I buy the stock, and if it goes 1% against me, if it goes 3% against me, if it goes 5% against, choose your number. That's where I get out of the position. I hate that, because what you're doing is you are applying your subjective thought process and subjective feelings onto the market as opposed to listening to the message of the market. So what we really want to be doing here as a team, or as traders, as professional traders, is we want the market to tell us what to do. So when you choose a random stop loss, I'm going to give this 30 cents. I'm going to give this 2%. It's exactly that. It's random. Why is that 2% important to the market? It's not. So when I'm choosing a stop loss, I am choosing a stop loss based on market technicals, based on supply and demand. I'm choosing a spot that's important to the market, whether it's an ignition bar low or a pivot low or something of that nature. Most of the time it's one of those couple of things. It's always going to be the market telling me what my stop loss should be. So when you're figuring out how many shares you take in a stock, how many shares you take in a trade, that's actually the last part of the equation. The two parts of the equation that you got to come up with first. One is what I call space risk. Space risk is the difference between your entry point and where you're planning on having your what we call an out. Another term for out is stop loss, right? So, and the second, I'll give some random examples. The second part of the equation is how many dollars do I want to risk? And that's how you know how much tier size you want to take. Space risk, okay, I know the answer. I'm risking 10 cents in this trade because the market technicals are telling me that 10 cents is the right out. Maybe it's a $10 stock, I'm risking 10 cents in it, right? I'm buying stock at $10, so my stop loss is going to be at $9.90. I've got 10 cents worth of space risk. The next question is, how many dollars do you want to risk? You want to risk $100 in the trade? Okay, now you know how many shares to take. The answer in this case would be 1,000 shares, right? So again, let me just run through that again. I just want to make sure, I'm just trying to do it as simple as possible to make sure everyone understands how to come up with their tier size. Space risk, that's the first question you're asking yourself. All right, I have, and let's take even a further step back. Let's break this down to its most simplistic form ever, like if I was teaching an 8th grader how to trade stock. The first thing I would teach an 8th grader is what a trade actually is. And this is one of my 3 important definitions, by the way, that I recommend everybody memorize. The definition of a trade, the definition of trend, and the definition of momentum. The definition of a trade is something with a technical reason and a technical out. That's it. A trade is something with a technical reason. Why is the chart telling me to get into this stock? What is it about this chart that I'm looking at right now across multiple time frames and all our layers of probability and everything else that is actually giving me the trade entry setup, my technical entry? And what is my technical out? Out, also known as stop loss. Where am I getting out of this trade when I'm wrong and why? And it also should be based on the technicals. Again, you let the technicals tell you where your stop loss should be. So in my basic example here that I'm just making up, I'm buying the stock at $10, maybe it's a $10 resistance breakout, and I'm using my stop loss at $9.90. I got 10 cents worth of risk, and the reason I'm using that stop loss at $9.90, that's my out, is because that's the low of the ignition bar on the 5-minute chart. So that is a technical reason and a technical out. That's my space risk. The next question you're asking yourself is, how many dollars do I want to risk? And the way you come up with the answer to that is based on a couple of factors as well. Factor number 1 is your account size. I don't really risk $100 in trades anymore. I risk more than that. Another person, maybe $100 is a lot of money, right? You need to risk the appropriate amount of dollars for you based on your account size and your experience level. And secondarily to that, not to make this too advanced, but the guys on the team, if you've gone through my training program classes, you should know that at a certain level of experience, I actually don't recommend this probably in the first 3 to 6 months of your trading career, but at a certain level of experience, you should create for yourself what I call a risk skew system. And the risk skew system, where your trade falls into it, is based on really probability of success, risk reward and probability of success. So what do I mean by that? How do you create a risk skew system for your trading? One way that I recommend doing it is by learning to grade your trades, giving your trades a letter grade. So you can have an A+ trade. An A+ trade is a trade where all the universe and the stars and the sun and the moon, everything is lined up perfectly for you for your trade. We have these layers of probability that we talk about a lot here. Layers of probability, and this goes to my probability class. Layers of probability is the terminology that I use to talk about the things that are affecting any trade that you're in. Really the things that are ubiquitous, specifically for my probability class. I'm talking about the things that exist in almost any trade that you could possibly take. For example, what is the market doing? If the market is moving higher and you're going long, you're going to have a higher probability of success than if the market is going down and you're long, right? So that's a layer of probability. Is this the stock or the market or the index that you're buying, is it relatively strong or relatively weak? If you are going long a market that is trending higher in a sector that is relatively strong, compared to the sector that is relatively weak. For example, today, financials relatively strong, tech relatively weak. If you're going long on financial today, you're going to have a higher probability of success, everything else held equal, than if you were going long a tech stock, right? So based on these layers of probability and also based on risk reward, you can create a letter system or a tier system for risk skew. So maybe, and obviously this then depends on your trading experience and your account size, maybe an A+ trade is something you risk $500 in. Maybe an A- trade is something that you risk $400 in. A B+ you risk $300 in. A B- you risk $250 in. A C trade you risk $100 in. And if it's less than a C, it's a garbage trade. You don't risk anything in it. You don't take it at all, right? You create that system for yourself. And then finally, the last piece of the equation is then how many shares do you take? So shares taken is based on space risk times dollar risk times divided by, oh, how would that math work? I don't know. It's your space risk and your dollar risk. So again, to use my basic simple example, you're buying a stock at $10. Your stop loss is going to be $9.90. That means for every 1,000 shares that you take, it's $100 worth of risk. So if your risk skew system calls for you to risk $100 in this trade, you buy 1,000 shares. If your risk skew system calls for you to risk $200 in this trade because it's a little bit of a better trade, then you take 2,000 shares. Now, I actually recommend, if you're a brand new trader, if you're just getting started in this, to not use a risk skew system yet because it's a little bit too complicated. And the reason why I can say that is because I was once a brand new trader. I remember when I was a new trader, there's just so many things that you're trying to figure out. And this whole grading system on trades and recognizing all of these layers of probability that we talk about, when I was a new trader, at least my first 6 months here, I was not good enough. I was just not skilled enough. I was not experienced enough is probably really the right word. I was not experienced enough when I was a new trader to be able to tell in real time all of these different layers of probability that are coming together that makes this as an A+ trade versus a C trade. And if you're not good enough to be able to do that yet, and again, I shouldn't say good enough, the right term is really experienced enough. If you're not experienced enough to be able to tell all that in real time yet, because you haven't seen enough situations in front of you, that's just fine. And that's why I actually recommend, even though I think it'll be limiting to your P&L, I recommend if you're a new trader, just to risk the same dollar amount in every trade that you take when you're new. Not the same tier size, the same dollar amount. So let's say you're a new trader and you decide, all right, I'm a new trader, I'm trying to get my experience, I'm trying to learn all this stuff. There's so much to learn. Oh my God, it's crazy. The cool thing about being a new trader, by the way, though, is like the learning curve is like so sharp in the beginning. Like, so here I am, over a decade later, and I still feel like I'm learning new things on a regular basis as a trader, but that rate of acceleration, rate of learning is nowhere near what it was like in that first year. The difference between, some of you guys who are new traders might be able to vouch for this, the difference between what 1 month in versus 3 months in versus 6 months in is like massive if you're putting the work in when you're a new trader. So I actually recommend when you're a new trader, because you're just not good enough yet, you're not experienced enough yet to recognize these things, to actually risk the same dollar amount in every single trade that you take. So you choose that amount, $100. And then, okay, this trade is 10 cents worth of risk, I'm taking 1,000 shares. This trade is 20 cents worth of risk, I'm taking 500 shares. This trade is 25 cents worth of risk, I'm taking 400 shares. This trade is 50 cents worth of risk, I'm taking 200 shares. That's how you come up with your tier size. It's space risk by the amount. Now you become more experienced. You start to be able to internalize those layers of probability. You start to be able to type up a chart and instantly see every single thing on every single time frame and know if it's relatively strong, relatively weak. Like I can look at a chart and I can recognize all of those pieces of information, all of those layers of probability, like in like a second or two. And that, again, just kind of comes with experience. I couldn't do that when I was a new trader. I just couldn't. It takes a lot of time. But I'll tell you what I could do when I was a new trader, is I could always see it in hindsight. When the market's closed and my P&L's not flapping back and forth and the tape's not running like crazy and the emotions and heartbeat's not accelerating, I could look back and I could go, oh wow, this was actually a really good A+ trade because this was on its side, 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 this was on its side. I could look back after the market was closed and I could say, you know what, this trade, it was, yeah, you know, it really wasn't that great because, yeah, I got in here, but my stop loss wasn't the right spot. I really should have been given it this amount of space, and, you know, I'm buying the stock, but the market's breaking down, and, you know, whatever. I could see all that perfectly in hindsight, and guess what? You know, people always say, like a common expression is hindsight's 20/20, and people say it like it's a bad thing. It's not a bad thing. There is nothing wrong if you're a newer trader in this business to only be able to see things in hindsight. Because, and as a matter of fact, I would say it's actually really important to be able to see things in hindsight. It's really important to do your after market closes work, right? When we finish this afternoon meeting, you guys should not just immediately shut down your computer and go about your day. That's not how you're going to become successful in this business. You're going to become successful in this business by reviewing every single trade that you took throughout the entire day, writing it down, talking about it to yourself. You're going to become successful in this business by making a friend in the ProDesk virtual trading floor, who maybe is a peer, or maybe is a little bit more experienced than you, who you could say, all right, Jimmy, market just closed, I just reviewed my journal, let's swap journals, let's review each other's work, let's give each other feedback, and then you can re-review your own work with that other person. That's how you become better, is by seeing things in 20/20 hindsight. Because this business, the way you get that experience, it is all about repetition. It's all about repetition. I used to be a professional fighter. I think a lot of people know that. I fought professional kickboxing. The way you become really good at any sport is by getting out there and doing it, right? You want to become Kobe Bryant, you got to get out there and you got to be on the basketball court and you got to shoot and shoot and shoot and shoot and shoot and shoot. And if you've never played basketball before, you're not going to get out there and have a one-on-one with like a professional basketball player and expect to get anywhere close to the net. You probably will never even get a shot off. You probably never even hold the ball in your hands because you have zero experience. You got to learn how to dribble first. Then you got to learn the proper shooting technique. And then you got to practice on your own. And then that stuff can finally come together. So it's repetition. The thing about trading is that we can't get on the basketball court after the market's closed necessarily, right? Because the market's closed. And unfortunately, like every time you take a trade and you're kind of trying to garner that experience for yourself, you know, you're putting money on the line. But there are techniques that we can utilize that can enable a newer trader to get through the learning curve faster than they would otherwise, and to be able to get more experience. And part of that is seeing things in hindsight, right? By doing journals. You journal every trade you took, that's the second experience of that trade you took. You meet with your partner, that's the third experience of every trade that you took. You do visualization exercises of your trades, it's the fourth experience of every trade that you took. You know, you can put together techniques like that, and you could get a week's worth of experience out of every day, as opposed to the guy who is here from 9 to 4 and then shuts down, and then that's it, right? So you learn to see things in hindsight, and then that's how you learn to be able to see things in real time. Because I can tell you for sure, I was probably 6 or 8 months in my career the first time I really felt that I was able to see an A+ trade in real time as it was happening. So if you've been here for 2 months and you don't have trading experience and you think that you're God's gift to trading and that you just know all this stuff, I'm sorry, you don't. You don't. And it's not a downer on you or anything like that. It's just an experience thing. So, you know, you just keep focusing on the principles that we talk here as a team and you'll get to that point. But that, to wrap things up, to not get, you know, too far off topic, that's how you come up with tier size. It's the last part of the equation. First is space risk. Space risk is told to you by the chart. You don't say, oh, I just want to risk 10 cents in this. The chart tells you. Then is dollar amount. Dollar amount is subjective based on you. It's based on your experience level, your account size, the things that we just discussed. Possibly you're implementing some sort of risk skew system. I really do think a risk skew system is the key to making big money in the market. And then you know what your tier size is. So I guess with that said, I don't really have anything else to talk about tier size. That's how you come up with it. So I'm happy to answer any questions that anybody has here. I'm going to scroll up a little bit in the VTF. Links to the previous days. Not sure what's happening. Hopefully you got that fixed. Scrolling down here, just some chatter about some stuff after earnings here. Clear up to Robert's question. Aaron's question's not on tier sizing, but I'll answer it now anyway. Do you listen to Reddit, Wall Street Bets, the Stock Guy, anything outside of the VTF? I don't listen to any of the things that you mentioned. I don't even know what the Stock Guy is. I'm not on Reddit. I do follow Wall Street Bets on Facebook a little bit, and I can only spend so much time on there because it's brutal how little these people know about anything, but I do it just to get like a sense of things. Like, for example, one of the things that made me like the Robinhood IPO more than I would have otherwise was because I saw how many people were bashing it in the Facebook Wall Street Bets group. I do look at this website that someone here on the team had sent me at one point, which is the YOLOstocks.live, just to see, because it just tallies it for you, just to see what Wall Street Bets is talking about. So UPST, okay, obviously it had earnings, so people are chatting about it in Wall Street Bets. But sometimes this can potentially put stocks in play for obvious reasons. So I do pay attention to that. But I don't listen to any things you just spoke about. I have podcasts I listen to somewhat religiously. I listen to the Pivot podcast with Scott Galloway. I'm always interested in his take on tech stocks. I listen to the Animal Spirits podcast with those guys from Ritholtz Wealth Management, the Josh Brown guys. I listen to not as much as I used to. I used to listen to it pretty religiously, but I listen to Masters in Business with Barry Ritholtz because he gets, for his guests really, he'll get some really good hedge fund managers on there sometimes. That's always interesting to see what they have to say. I listen to what's the Patrick O'Shaughnessy podcast, Invest with the Best, I think it's called. I listen to that occasionally. Again, less so than I used to. I feel like these guys, not saying bad about them, they've got great podcasts, but I feel like they kind of start to run out of strong guests after a while. So I do listen to all that stuff pretty religiously. I'm kind of nonstop, if you guys don't know that about me, as far as trading and markets and research goes. Like it really is nonstop for me. Like I'm constantly listening or watching or reading something about markets. Like it almost feels like 24/7. Currently reading a book. That's the one thing I don't really do much of anymore. I used to read a lot of trading related books. As a matter of fact, it used to be the extreme opposite. I don't really have time to read books so much anymore. But when I was a new trader, I was able to get a list of, it had like 200 financial related ebooks. And I was a new trader. I was doing everything I possibly could to get my fingers on anything that could give me an edge. I read so many books back then. I remember, and anything. I would read literally anything. Maybe there's going to be I remember reading this book about tape reading in the 1940s or 50s or something like that, and it just did not apply to the market now at all. That was fractions, this is decimals, it was the 50s. But I was like, you know what, if I read this entire book, maybe there's just one sentence in here that can change my thought process about markets, that can give me an advantage. And I sat there and I read the entire thing. Learned, I know how to tape read if the 1950s market ever comes back. That's how I used to be. Right now I'm reading Diary of a Black Man on Wall Street, which Greg here in the VTF gave me because apparently he's mentioned in it. So getting through that right now. So hope that helps, Aaron. Gabriel here. In a day where I am already green some money, could I risk a bit more in a trade that I like, a setup I like, or do you recommend sticking to my risk tolerance? I mean, if playing with the house money in that trade. I answered it. Okay. Yeah. Not to get too much into money management today, because we could easily do like multiple afternoon meetings on money management. But you guys want to give yourself what I call a limit up down on your good days. One of the worst things you can do, let's just say making $1,000 is a good day for you. You should never allow yourself to go from up $1,000 to zero or to negative on any day ever. But I am also not a believer in just stopping at a high watermark of P&L. I don't just get to $1,000 and go, oh, $1,000 is good for me. I'm going to close out all my positions and go for a swim. I don't do that. If I'm up $1,000, I want to be able to turn $1,000 into $2,000, $2,000 into $5,000, $5,000 into $50,000. And this goes back to my principles on money management, which is always limit downside and leave upside as unlimited as possible. But at the same time, you should never be giving a good day into a negative day. So you look at your P&L, and it should be really closed P&L. So if you're up $1,000, but you've got $900 in open risk, you're not up $1,000, you're up $100. So when I say you're up $1,000, maybe that actually means your software, your trading software says you're up $1,400, but you've got $400 worth of open risk based on your current positions. If these positions go against you, you're going to be up $1,000 on a day. I am for trying to push it a little bit to be able to make you even more money, but not to the point where you'd be willing to give back that entire day. So you ask yourself, all right, I'm set to be up $1,000 at this point. How much of this money, this $1,000, am I willing to risk in order to make even more? Maybe the answer is $400. So that means that if your P&L ever gets to $600, you are done for the day, but you gave yourself that extra room, that extra space to be able to turn that $1,000 day into a $2,000 day, $2,000 into a $5,000 day, $5,000 into a $50,000 day. So that's what we're trying to do here. From TJ here, I can attest to this. I've been an advisor in the investment field for 10 plus years. First time trading full time. Trust me, I never knew I could lose this much money this fast. Learning fast, this is risk management. Yeah, especially at the professional trading level. Professional trading is 85% risk management, 15% reward maximization. Especially with the capital access that you can get like in a professional trading account at T3. It is all about risk management, and then when things are working out for you, being able to let them ride so that you can make big money for yourself. That's the whole advantage, obviously, of having that capital access, is that when things are going right, you can make significantly more than you just could in a retail account. Retail accounts are also, cash accounts especially, much more forgiving on mistakes, risk management mistakes, than a professional account, because you're never going to get a margin call on a cash account, right? You're never going to blow up a cash account. It's going to, or at least it's very, very hard to be able to fully blow up a cash account. So you can make more mistakes in those types of accounts, and they can kind of come back for you or come back with you. So risk management is the key to the business. Next here from Rich, when you were a new trader, how did you get over the psychology? The past 2 weeks, I've been up and down every day, and my P&L is flat. Did you do anything besides experience to not yo-yo around and have a steady increase? Yeah, so I mean, I've heard people recommend like hiding your P&L. I've never been a fan of that. But like they say, like, oh, if your P&L is affecting the way that you trade, you should be trading everything the same, so then you can hide your P&L. I'm not a fan of that, because I think you do need to see your P&L in order to do the risk management and money management things that we just were discussing. The biggest, I think the biggest weapon that we all have against negative human psychology that naturally negatively impacts our trading is game planning. When I was a new trader, it's funny, I actually have it right here. I've got notebooks full, and this is one of my old notebooks. I actually just kind of found this recently, and I was going through this to pull some information on here. I have notebooks full of all kinds of stuff in there, but particularly game plans. When I was a new trader, pre-market, when I was doing my pre-market research, I used to write down every single potential trade that was out there, right? So I've got all this list of trades that are on my watch list today. Some of them triggered and I was involved in them. Some of them triggered and I wasn't involved in them. And some of them just didn't trigger at all, so I would never be involved in them if they didn't trigger. But I used to literally hand write out a game plan for every single potential trade that I was able to identify pre-market. And then just follow, this is what I used to tell myself, and this is not what I'm saying to you. I used to say, follow what's written on the piece of paper, idiot, to myself. Hey, stupid, follow what's written on the piece of paper. You already did all the game planning before the market even opened on what you were supposed to do with this trade. Now just do it. So now guess what? If I'm just following what's on the piece of paper, I was able to write that out when I was able to look at the market much more objectively than I can now when I'm seeing my P&L, to use your term, yo-yoing back and forth. My P&L today, by the way, was all over the place. Even after hours today, my P&L is still swinging back and forth. But it doesn't matter. It doesn't matter what my P&L is. It doesn't matter if I just gave back some money or my stock just pulled back or it just went up or feeling good or I'm feeling bad or my girlfriend broke up with me. Nothing matters. All I gotta do is follow what's written on the piece of paper. The psychology does not matter. Follow what's on the piece of paper. Follow the game plan. That's our number one thing that we can utilize to battle our own psychology. And our own psychology is definitely, the biggest weakness of kind of just being a human being trader. It took me, I was just talking to somebody about this actually recently. It's only really been in the last couple of years now where I don't care what my P&L is. I just care about doing the right things. Like truly, like truly don't care what my P&L is. I don't care if my P&L is green or red or anything like that. It almost is hard for me to remember what I made or lost yesterday at this point because it's entirely about process for me. But until literally just very recently, I still couldn't do that. I would still be, affected by seeing, oh my God, I'm down huge on the day. Oh my God, like I'm up big on the day. And now it's just really just about the process. Next here from Michael. I recently had what I call a perfect storm scenario. I had a great green streak for several weeks, was up a lot for my account size. I started to skewing risk and got whacked on literally all the larger size trades I took. Literally gave it all back. I thought I knew what my A+ setups were, but I'm realizing it's still too soon after 5 months. I couldn't agree more with you, Derrick. Yeah, I mean, look, trading is a process. A lot of trading, I can tell you from my own career, is 2 steps forward, 1 step back. 2 steps forward, 1 step back. Sometimes 2 steps forward, 2 steps back. 2 steps forward, 1 step back. 2 steps forward. It's just kind of hopefully always having more steps forward than steps back. Sometimes it's even 2 steps forward, 3 steps back, 2 steps forward, 2 steps forward. I could get up here and do a dance now that we got the camera going on. But I mean, it's just part of the business, especially the market environment changes. One of the most difficult things for traders, period, regardless of experience level, is a change in market environment. So Michael, this even could be for you. The market got a lot tougher in July. Starting after like the first week of July and here into the beginning of August, I honestly think that the market got significantly tougher than any other point in the last 2 years. So it could just be, you were doing really well, you're doing all the right things. Market got tougher just as you decided to, expand upon your risk and, hit you back a little bit. I would still argue that you're making good progress, for the amount of time that you've been doing this. You're not even fully through the learning curve. You're 5 months in, 6 months in. You're not even fully through the learning curve. But you're also at a pivotal part here where we definitely want to start seeing you throw up those profits. So just keep at it. Robert is looking for an accountability partner. Cool. Somebody get with Robert. Could you repeat the name of the podcasts? Yeah, so I follow Pivot with Scott Galloway. If Scott's not on there, if it's only Kara Swisher, I have no interest in learning. In listening. I'm really trying to hear for Scott. He has his own podcast too, which is called the Prof G Show. I actually prefer to listen to it with Kara Swisher because she'll ask him questions that can get things started, but I actually don't really like her or what she has to say, to be totally honest. So I listen to that. I listen to Animal Spirits, which is those Ritholtz guys, mainly because they keep me abreast of a lot of news and a lot of statistics. So it's like, they work with that guy Josh Brown, who's on TV all the time, the reform broker. So then you got Invest Like the Best with Patrick O'Shaughnessy. Invest Like the Best. And I'm listening to him primarily for the guests he gets on. So I don't listen to every single one. I selectively listen to it based on the guests. And same thing with Masters in Business with Barry Ritholtz. It's also based on the guests he has on. If he has somebody who seems really interesting, that's kind of when I'll come in and listen to it. So those I guess are kind of the main ones I go back to somewhat religiously, and then there's always a lot of one-offs. I'll have somebody say, "Hey, Derrick, check out this podcast," or "Hey," or I hear that Scott Ruther was on somebody's podcast, so I'll download that one and kind of listen to it and see what the Red Dog has going on. So that's basically that. Next here from Brian, what time frames are you using for your stock picks on a day-to-day basis, I guess is the question. Given the market is currently choppy and moves don't occur as quickly, are you avoiding those names in SPY and Qs? My main chart is the daily chart. The daily chart tells me what I want to be involved in, how I want to be involved in it, really for the most part. The small time frame gives me the execution off of the things I like on the big time frame chart. So one of the things you'll hear me talk about a lot is using intraday risk for daily chart reward. So everyone talks about risk reward ratios, right? I want to have 3 times my risk on reward. I want to have 5x my risk for any trade that I take or whatever. That's not how I really view it. My favorite trades are the ones where I think that the reward is unlimited. How do I know the reward is unlimited? Well, I mean, if the market is trending in the direction of your trade, and especially higher, like if you're long a stock that's at all-time highs and trending higher, in theory, your reward is infinite, right? And we might think, oh my God, infinite reward, like Derrick's being ridiculous at this point. But you don't have Microsoft from $40 without having that principle. Look at this uptrend in Microsoft. You could almost have this for the entirety of it. You just don't capture those big moves without that thought process. So what I like to think about is daily chart reward for intraday risk. So I know that 290 is the key next level in Microsoft. I know that 150 is the key level here for Apple, and that Apple has built out this wedge. I want to be able to find. I can even use Apple as an example from a trade that failed yesterday. Apple had a lot of things to like yesterday morning. It was very relatively strong. We know the daily chart is a wedge. We know 150 is a really big key level. We know the Nasdaq's at all-time highs. I've got many things on the side of my trade. I got a 5-minute bull flag. I can come in and I can buy this 5-minute bull flag in Apple at 147.50 and risk, 40 cents in this. Basically was the risk on the trade. Trade failed, by the way. The market broke down very hard right after I got in. But think about this risk reward. I'm buying here because of the daily chart. I'm not buying because of the 5-minute chart. I'm buying because of the daily chart. Because the wedge in the daily chart at that time was trying to break up. And if the wedge on the daily chart breaks up and it clears 148, it's going after 150. If it breaks 150, it's breaking out to all-time highs, and maybe you can repeat this move that led into this bull wedge. This move was a move from, let's just call it, 128 to 150. Maybe I'm looking at a move to 175 in Apple. I'm buying because of the daily chart. I'm not buying because there's a 5-minute pattern. The 5-minute pattern is my small time frame execution. So if I can come in because of the daily chart and execute for 40 cents risk in Apple, but I have the potential, even if it's a very small probability of this working out this perfectly, I end up catching Apple to $178, think about the risk reward. $175. I just came in and I bought Apple at $147.50 for 40 cents worth of risk, and I am looking for a move that's going to be $27.50. I like that risk reward. And then guess what? When I'm at $175, I'm not just getting out. Maybe the next pattern builds up and it goes to $200. Again, you don't have Microsoft from $40, basically like I do, if you're not willing to trim and trail and give back open P&L and, you know, do that. That's what you want. So that is the thought process and time frames. Everything comes from the daily chart, but the execution is going to be primarily coming from the smaller time frame. Nice, Aaron, love it. Natalie just sneaking in a couple of names she wants me to look at. Datadog looks great. You know, technical correction to the ADMA and pivoted back up today. Mara looks fine as well. You know, got really extended off this 2-day move, so it needs to build out a consolidation, let this moving average catch up. But they both look solid to the long side still. The Truth of the Stock Tape. I just got an ebook from EJ. Eric here, piggybacking on Gabriel's question, I already forget which one that was. I try to avoid over trading after I'm up, but also understand you should always avoid over trading. But also understand that there is still plenty of room to make more. But the second half of the day seems slow with weak moves that stop me out. There's certain types of setups that are better during the slower hours of the trading day. Sure. So Eric, one of the layers of probability for my probability class is time of day. So if you are taking a trade at noon, that trade inherently has a lower probability of success than a trade that you're taking at 9:40 in the morning. I break time of day into categories. The highest probability time of the day is 9:30 to 10. The second best time of the day is 10 to 11. Third best time of the day is 2 to 4. The worst time of the day to trade is 11 to 2. So if you're trading in 11 to 2, I'm not saying don't trade 11 to 2. I'm saying you inherently have a lower probability of success if you're trading between 11 and 2. So do I want to be pushing things as a general rule at noon? The answer is no. If I'm typically going to have a lower probability of success at noon, does it mean I should be more or less selective with what I get involved in compared to the trades I'm getting involved in at 9:45? The answer, without a doubt, is I should be significantly more selective. I don't put a lot of trades on after that first hour of the day. For me, I am mostly executing any new trades in the first hour of the day. I'm not saying entirely, I'm saying mostly. And then I'm spending most of the rest of the day doing position management. That's it. I'm mainly just, take off a little bit of stock, rebuy a little bit of stock, make a little bit of cash flow for myself on some of these ranges or what have you. That's what I'm doing at that time of the day. And then Eric also has a follow-up question. Will buy stops be filled at the market open if they are placed during pre-market, or are those stops ignored if they are not placed during normal market hours? Stops do not work pre and post market. Do not put stops into the market pre and post market. If you have a buy stop that you want to put into the market as a trigger or as a stop on a short or whatever, you got to put them in at 9:30. From David Dean, long on Google. Google is like possibly my favorite FANG stock right now. A little bit of a weaker day today for it. I've been talking about Google as a long for a while, but most recently since this pivot low on August 3rd, gave a nice little pit. So earnings day, earnings were solid. YouTube is like $1 trillion company almost in and of it unto itself. Pulled back to the ADMA here on the daily, gave a beautiful pivot followed by an inside day. So I really liked this little daily setup to come in here and go long. There hasn't been great follow through. There was weakness in it today. I still like it. My concern right now is continued relative weakness in the NASDAQ compared to the IWM. So I like it if you're in it. If you're not already in it, I wouldn't get in it now. If you're already in it, follow the game plan that you have for yourself. Implement trailing strategies. Make sure you're locking in your profit. Book a little bit of profit if you're in the money, whatever. So I like the stock a lot. I don't like getting into it right now without a new setup. So the last real setup I'm seeing in it is the one that I just kind of went through there on the daily chart. And again, my concern right now on these big tech stocks is the relative weakness in the Qs. Even though there's been no breakdown and the Q daily chart is still bullish, I'm not a huge fan of these last two candles. And I definitely am keeping a close eye on Apple, because that Apple trade that I took yesterday really turns into a failed breakout of the pattern where I lost money. And there's a potential from a failed breakout to that leading to a failed pattern. If this Apple wedge breaks, there's really not much to the left here once you start clearing some of these support levels. And I could be concerned about a fast down move in Apple should it actually start breaking down. So I just have a little concern from relative strength, relative weakness on big tech right now. But overall, I mean, Google is kind of always solid. No problem, Brian. Baba, Natalie, assumes what you meant there. Yeah, Baba looks okay. I still like these companies a lot. It's built out at a wedge. It needs to get above $200 and break that wedge to the upside. Where should I go to properly learn how to read earnings reports? We just kind of went over this a little bit in an afternoon meeting the other day. I kind of just went over my process for earnings reports. Although I consider my approach to trading to be 85% technical, 15% fundamental, I am by no means like a, what do they call that stupid thing that the people study for with 3 tests? CFA?
I just failed level 3.
You just failed level 3? All right. Just probably insulted like a quarter of the people in the VTF. I'm by no means like a CFA coming in there and reading all the fundamentals. I'm a big believer in what I call qualitative fundamentals, which is the story, the management team, the sector, the company environment, things of that nature. I do just pay attention to the earnings reports. We went over this the other day. There's like 4 main categories. There is beating or missing on EPS, beating or missing on revenue, and then a little bit more importantly, beating or missing on earnings guidance and revenue guidance. So you got those 4 things to look at. And then like a great earnings report would be beat on earnings, beat on revenue, guide higher, guide higher. Terrible earnings report would be miss on earnings, miss on revenue, guide lower, guide lower. And then everything else is kind of in between. Usually guidance is more important than the past. Other factors to pay attention to that can be big are buybacks and dividend increases. So I pay attention to those also. But look, and I just, we're at the tail end of earnings season here. I definitely went over this already during this earnings season. You can't just see a stock beat, and press the buy button and expect to make money. Because analysts, what are they beating? They're beating analyst expectations, and that we think that analysts are jokers, right? That's what we think. That's the collective we. We think that sell-side analysts are to be looked down upon as lesser human beings in finance and on Wall Street compared to traders who actually move money. And I'm not going to get into that whole tangent again because I just got in that tangent about 2 weeks ago. But that's like when Pat's posting all the earnings information into the ProDesk virtual trading floor every morning. I'm scrolling through all those names, I'm typing them up, I'm looking at the daily technicals, and I'm doing a quick read on the 4 factors, plus is there any new buyback or dividend information in there. Scrolling down here, looks like I got through all of the questions, so that's perfect. And we are a little bit after 5. Oh, we got one more here. Dylan wants me to check out PNFP. And I appreciate the compliment. PNFP. Oh, I like this chart. What is this company? PNFP. Pinnacle Financial Partners. I'm not sure what this is. Is this like a regional bank? I'm guessing it's a regional bank. I love tight upper level consolidations within the confines or after the breakout of a bigger consolidation. And that's exactly what we got here. I'm assuming this is a regional bank. I'm not 100% sure. We've obviously seen the banks, the XLF, perform excellent. So relative strength is definitely there. My concern on the XLF right now is the move. Is really big and really fast, especially for financials, how they typically move. Financials, Bank of America is not really a momentum stock, right? So this is a big move in a short period of time for financials. So I really want like the XLF to reset up before I get in. But as far as this Pinnacle goes, check that back up again, PNFP. I love this chart. I love this chart. It's not extended. It's built a bull flag above a 1, 2, 3, 5 month consolidation. Love it. I think you can be long this thing versus 93.78, and if the TLT keeps bleeding lower, this thing looks money. This is a solid looking chart. Thanks for bringing that to my attention. Someone can remind me about this PNFP, someone on our team. I love it. A guy on YouTube coming through and giving me something I want to look at for tomorrow. If someone can remind me tomorrow morning when we're doing our morning meeting, take a look at this again tomorrow morning to see how it's gapping. Maybe we add it to our game plan a little bit. What was your thinking about the ZEV trade that I took today? I have been tracking them for so long. Oh, really? I've never heard of this company until yesterday. And myself been waiting for confirmation. Now that it came in, I feel like I missed a big part of the move. Yeah, we definitely did. Pat posted the information on this thing yesterday. I don't like how they closed this at all. So yeah, this ZEV here, I spoke about taking a trade on this thing versus like $10 or versus yesterday's low. I was involved in it. I didn't do a fantastic job overly sticking with this trade just because of, for me, it's just, again, it's about position management with all the positions I have on right now and kind of total buying power I have. Basically was thinking, all right, this thing's opening up in the mid portion of its range after a huge day. It looks like a new speculative name. This 950 was a big level that it got back above. It held that as support yesterday. Probably could give an inside day today is what I thought, a little bit of a tighter inside day, or possibly a day 2 higher. That's really what I thought could happen. I normally don't like buying day 2s, but when it was set to open in this, like, where did I even get involved in this? Like, I got involved in this, I think my price was about 1050 or so. So I figured for a price of 1050 to take like 50 cents risk or a little bit more on the potential of this to wake up and have a day 2, it could be a solid one. So that's kind of what I was thinking. It did wake up and it did try to go here, and then it just kind of totally failed. It even got above yesterday's high a little bit. I mean, this was just a solid intraday move from 1050 to 12, but then it rolled over and failed. I don't like how this candle closed today, so I don't have a position in this. I am interested in getting back involved, but I think it needs more time. I want this thing to hold above 950. I want to build out a pattern. I want this ADMA to catch up to 950. I think we can start looking at it again. That's that. Pat here providing some information. Pinnacle Financial Partners is a bank headquartered in Nashville, Tennessee. I've never been to Tennessee. I've never been to Nashville. It's on my list. I got to get down there for a visit. Sebastian, do you trade small caps? I trade small caps. I trade cheaper names. I don't trade OTC stocks, which is where a lot of the small caps are. I'm not afraid of trading cheaper stocks. I generally don't. So, like, we've made a lot of money trading this sundial this year on the 2 Wall Street Bets occasions. This first move here, I didn't capture the whole move, but I caught a chunk of it. And then Will here in the VTF said literally on this day, on May 25th, when we knew Wall Street Bets was waking up again, he said, hey, it might be worth it to come in here and buy some of this sundial again around 75 cents. Because if the Wall Street Bets thing comes back to life, this thing could double really easily and quickly. And if the Wall Street Bets thing doesn't come back to life, it'll probably still be around this price where you can get out. And I like that idea a lot. So that was my plan. I got in this thing at 75 cents, and I got out of my entire position on this day. When it basically doubled. It did exactly what we were looking for. So shout out to Will in the ProDesk VTF for making me some money on that one. I owe you lunch, but I think I already bought you lunch recently, so I guess we're even. So I will trade some of these stocks. I usually don't like trading stocks that are cheaper than really $5 unless I think the thing can like literally double in a short period of time. It's not really worth it for me to trade dollar stocks and $2 stocks or penny stocks unless I really think that I can get an actual 100% move in it in a day or two. So I don't go to this stuff too much, to be honest. If it's less than $5, I like things that are a little. My sweet spot for trading is really stocks between $10 and $75. That's my real sweet spot. I love cheaper names that have volatility. By cheaper names, I mean like that SoFi that I've been trading a lot of. That it's got a lot of volatility. Like the $17 Wish, we were trading kind of into this move. I love those cheaper priced stocks like $10, $15, $20, $30 that have a ton of volatility for their dollar price, because they've got a lot of volatility. I can make money off that, but they also tend to be really liquid. I don't like the really expensive ones, like even that UPST, which I traded this on a few occasions kind of in here. Even this thing, $130 stock, like it's just a little bit spready and moving a little bit wild with that spread, where I will take them. Or Tesla, I will trade Tesla. I just don't go to it a lot. Hear me all the time talk about how I want Amazon to get broken up so bad. Ooh, Amazon broke lower. Somebody asked me about Amazon yesterday's afternoon meeting. I hope you're making some money. Like Q relative weakness come into play here. But these things are just not good day trading vehicles or short-term swing trading vehicles because of the expense and the spread. I am all for breaking up Amazon. The sum of the parts is going to be worth more than the whole. Let's see if y'all got anything else for me. No problem. Thanks, Ariel. All right. Oh, wait. Here's one more. What do you think about ZIM? Z-I-M. At $43 with a stop loss of 41.20. It's a decent looking chart. 41.20 is this pivot low, so I see exactly what you're looking at here. Yeah, I think that you could actually maybe even have a little bit of a tighter stop on that. I think you could use today's low. You need this thing to get above and clear above 43. So I would probably, 43 is your trigger price. Perfect. I was about to say, I would probably use 43 as a trigger price, but that's exactly what you said. So yeah, I like it. 43 is your trigger price. If you can get back above that tomorrow, and you could use that low here that you're referencing. But honestly, if it's really clearing 43 and it gets above today's high, I think utilizing today's low as a stop, which is a little bit tighter, should be just fine. If it's really clearing 43, it should never be able to get back below this low if it's correct. And again, those are the stop losses I'm trying to choose, is the stops where I am knowing that I'm wrong. For me, I accidentally got into QS with a limit order instead of a buy stop, which effectively cheated on the buy stop entry. I held it to see if it played out off the open. My stop was yesterday's low, but I guess it should have been the opening low as a buy stop trigger. On a mistake like that, would you hit out? Usually the answer to that is yes, but not always. Wow, like QS failed today. What did B-Fly do? Yeah, B-Fly broke yesterday's low and came back. Yeah, I really don't like this company on QS. So it depends, ET. I could totally see in the specifics of your case actually letting it play out with that stop loss. But generally what I recommend is if you press the wrong button, just negate the mistake as fast as you can. And if it costs you any money, I call it the idiot fee. Not calling you an idiot, it's just what I call it. It's the idiot fee for pressing the wrong button. Like, if you got some transaction costs, or you're paying the spread, or you buy out or sell out at a little bit of a worse price than you got into it, and it costs you $5, then the idiot fee there is $5. I've had idiot fees that have been in the hundreds of dollars. So if if your idiot fee only costs you $5, I've had idiot fees that have made me money also, though, to be fair. I remember when I was a new trader trading Netflix, and there was like a spread on it, and I accidentally market bought, and I freaked out, and I market sold, but I accidentally sold double my position. So then I market bought again to try to get out of it, and whatever I did, I ended up paying the spread back and forth like 4 times on like a couple thousand shares, and like blew like my entire day. And yeah, that was a big idiot fee that I paid that day. But generally what I recommend doing is negating the mistake right away. Get right back in your trade, or get right back out of your trade, or whatever it is you need to do. All right, gang, that's it for today. Good afternoon meeting. Again, this market here has been really slow these last couple of days, so I'm happy to keep focusing on topics each day. Like today we made a topic for tier sizing, when the market's slow, if we have lesser to talk about right now, then it's August. Happy to keep doing more topic-related afternoon meetings so that we're still learning on a day-to-day basis, or whatever you guys want. Feel free to email me or whatever, and we'll do it. So ProDesk VTF, it's where it's at. If you're on YouTube or whatever and you're just watching, I think the first step to getting involved in the team is to reach out to T3 Live, become a subscriber, and then possibly we could talk about the next step of becoming a professional trader at some point down the road. So do it. Do it. Have a great night, everybody.